me ask you firstly about the numbers you're announcing this morning. And you're talking about these net outflows for the full year. They do look to be a little bit lower than anticipated, which maybe is good. But what are you seeing sort of in the most recent period? Because that's the full year number. What is the most recent story on out and inflows?
So, well, good morning, Anna. Good morning, Mark. It's great to be here. 2021 was a reset year for our company. And as the numbers are coming across the wires, you can see we delivered on all counts in the year. We're delivering on a strategy for growth. It's a 3-year strategy. This was the first full year of the strategy. We grew our revenues by 6%. We grew profit by 47%. And in so doing, we improved our efficiency from 85 to 79. I'm very focused on controlling the things we can control, and expanding margin is the 3-year plan. I started with a margin of 15%. This year we delivered 21. By the end of 2023, we fully expect to be able to deliver a 30% margin. So it was a great year for Aberdeen across the board. In terms of the most recent numbers, I can only comment, of course, on the fourth quarter. We actually grew our business in the fourth quarter. Yep. And across the full year, we grew Asia, we grew Europe, we grew the US. Our challenge remains in the UK, and our new chief executive, Chris Demetrio, and Rennie Billman, who run the investments business, are very focused on addressing that challenge.
Yeah. Stephen, good morning. As you say, 2021 was a reset year for you, and that reset is still on track and going well. I want to talk to you about the much covered in the media, your Rosneft holdings. I know it's only £5 million. It had been reported that you've been stuck with that. It's not a large amount, but obviously it is reflective of what many people are going through at the moment. And we want to know what in practice is your decision process around the holdings. Do you just write it off? Do you write it down? Do you wait to see what happens? Are you actively looking to sell it? Can you give us some more colour around that?
Yeah, I certainly can, Mark. So first of all, I'll just put the whole thing in context. So we as a firm have over £500 billion invested, and less than 0.5% of our exposure in total is in fact to Russia, Belarus, Ukraine. So it's a very small exposure overall. What we're doing is, of course, the Moscow Stock Exchange is closed. It closed on Monday. It's going to be closed until March the 5th. So Russia, Belarus is uninvestable, clearly, at this point. It's not a time to panic. It's a time for calm heads, of course. And what we're seeing in the market is there's a flight to quality. There's actually a flight to scarcity. Think about energy. Think about food supplies. When these conflicts happen, geopolitical conflicts happen of this nature, and there's so much uncertainty, you'd be a fool to predict the next path. But what we know is that people want to invest in scarce assets, they want to invest in strong business models, and they want to invest where there's great capital strength. And of course, we as a firm with minimal exposure to the conflict, first thing we think about is actually the human cost of the conflict. That's actually the thing that I think is most shocking, is we worry about, we never expected to see this in Europe. So that's our first concern. But from a financial standpoint, we are actually minimally exposed.
OK, obviously, yes, you're right to focus on the humanitarian side of things, but thinking about the financials then, minimally exposed. You say then that Russia is uninvestable, but what does that mean in terms of those assets that you do hold, Stephen? Does that mean, to Mark's point, you look to sell them, or you just sit on them, you freeze them for a while maybe? I mean, JP Morgan and Danske talking about funds, saying they're freezing funds that are exposed to Russian assets. What thinking is happening in Aberdeen along that front?
Well, the only reason that you actually suspend funds is if you have a rush of redemptions. In fact, we're not seeing that. We're seeing people sit on their positions. The fact that you can't trade Russian stocks, obviously, you can only trade through GDRs and ETFs. We've seen this type of thing happen before. This happened in Greece in 2014, where you had a local suspension of trading and you only had international trading. What we saw happen is that when you sat on positions until the markets reopened locally, that in fact that they traded very close to the GDRs and the ETFs levels internationally. So with professional investors, that's typically what you would expect them to be doing right now.
So you're saying that you're not seeing that kind of rush of withdrawals, so therefore there's no need to freeze funds. But is the implication that you will be quick to freeze funds if you do see those withdrawals? And is there any proactive planning around what you'll do around your Russian assets when the Russian market reopens next week?
Well, we are in constant communication with our clients who are invested there. Of course, people who are invested there have chosen to be invested in energy stocks. They have mandates that actually stipulate that. So they're experienced and professional investors for this space. This action, of course, was not fully anticipated, although we had been in advance of the conflict, we had actually been trimming down positions in conjunction with our clients. Our clients are most likely to sit on those assets as the crisis plays out, because they're experienced and they're looking at prior geopolitical events and what has happened in the course of investments. It's never a good time to be selling when the cannons are firing, and that's typically the stance of a professional investor.
Okay, so you say that it is not a time to panic, Stephen, and we take that on board, of course. I've been reading a bit this morning about where we're seeing money flowing into cash and investors clearly trying to find havens, or have been until today. Things look a little calmer in markets today. So money going into cash and cash-like instruments or ETFs that carry very liquid assets. Are you positioning portfolios in that way, Stephen? Are you talking to clients about that kind of activity?
Absolutely. We are identifying the safe haven assets. Our clients want to remain invested, so they are going where they are seeing scarcity, where they're seeing value. So I mentioned energy stocks clearly have trended high. You're also seeing that what happens when oil price shoots up and gas prices shoot up, you see increased interest in alternatives because it makes them more attractive. So we're also seeing that. As you know, we are a specialist in this area, that we are focused on sustainability. And as a company, when you focus on sustainability, you know where you can place your money for the alternative investment to carbon, because the world must decarbon. It's a shame that it's taken this conflict to make those alternative assets more attractive, but that is actually the case. That's what's going on. You're seeing core carbon go up, but you're seeing the alternative space also increase at this time. You're also seeing significant investment in broader commodities. You're also seeing investment in food and food supply, because scarcity in times of uncertainty is driving the investment thesis. You're also seeing investments in bonds, but typically shorter duration, as people tighten in to understand the way this is going to play out.
Stephen, really appreciate getting your perspective on this very kind of fast-moving and evolving issue. And I realize a lot of circumstances are changing. Given your role as a CEO of a major kind of UK fund manager, what do you think are the market implications from this Russian invasion of Ukraine that we haven't yet seen in markets? What is the next shoe to drop?
Well, clearly these sanctions are biting. They're clearly biting. You're seeing it out of the rhetoric out of Moscow, which has been an escalating rhetoric in a consequence of the sanctions biting. The SWIFT move is a very, very significant one, and you're going to see an attempt to move away from petrodollar, US dollar hegemony, if that actually stays in place. So I think that when you're going to look at RMB trading in oil, which clearly was already taking place, I think you're going to see that as a prevailing trend as the SWIFT action takes place. I think that also people are now beginning to look for the second-order effects of the crisis, and that's why I think if we believe that it's a prolonged crisis, then you could expect to see sustained higher prices in energy and in commodities. But you would start to see more of a story as to how do you get to energy independence? And I think energy independence, when the back end of last year, we were all talking about COP26. We're all talking about the path to a carbon-free economy. We as a company, as sustainable investors, are massively focused on doing that. We've made big commitments as a company, as a public company, to remove carbon from our assets by 50%. by 2030, and we're already doing it from our own operations. We think that this crisis is a further catalyst for focusing on a low-carbon future.